Hey guys, it's Willie. Today I want to take a look at Johnson & Johnson stock. As you can see, it's currently trading at $174.34. Over the past 6 months, it's up 6.07%. Call that 6% up over the past 6 months. It's looking pretty good. A lot of volatility, as you can see. Really, and that's not even over a long period of time. Just 6 months, and you're seeing quite a bit of volatility over the past year. If my computer will work. Of course not, because why would it work while I'm recording? You still see some volatility in it in Johnson & Johnson, which is rather surprising. A solid, stable company like Johnson & Johnson, COVID, they dropped 20%. I think that's the COVID drop, right? But yeah, I think Johnson & Johnson has some volatility. I think you definitely buy it as a long-term hold. So let's jump over to our spreadsheet and look at it from that sort of value investing long-term hold perspective. So as we can see, stock ticker JNJ for Johnson & Johnson, $174.34 is the current price. Starting with revenue up steadily at 3.38% a year. Net income is growing significantly faster than that at 6.76% a year. There was this weird year in 2017. There was some sort of special charge. I did some investigating with that just to make sure this number was right. It jumped out at me, and I couldn't fathom why JNJ would have a weird year like this, but this is the correct number, just so everybody knows. Some sort of special charge or something that took it out of the net income. On to our one of the most important metrics, if not the most important metric, is our free cash flow. This is what we're paying for when we're buying an investment. Growing from, call it $14 billion up to $20.5 billion. That's 3.89%. A little bit faster than revenue, but basically in line with revenue. Now, on to shares. We went from 2.8 billion shares down to 2.6 billion shares. Really, that's 2.8 billion down to 2.7 billion. It's almost 2.7 billion. But that still is a downward trend at 0.5% a year, which is what we like to see. Johnson & Johnson, I don't think they should be buying back shares heavily unless they simply can't find something to do with their cash otherwise. I think that the stock, as we'll see in a minute, is fairly valued. I'm not going to say over or undervalued. I think it's fairly valued, and so I don't think they should be buying back too many shares. A company that has an undervalued stock should be buying back shares. A company with overvalued stock should issue shares, and a company with a fairly valued stock should not do anything with their shares, just leave it as a flat number, or buy back. I mean, you can buy back at fair value, but you're not going to get. You'd rather buy it undervalued than fair valued. But anyway, on to earnings per share and free cash flow per share. Earnings growing at 7.3% a year per share. Earnings per share growing at 7.3% a year, and free cash flow per share growing at 4.42% a year. Good growth out of such a big company like J&J. Total assets, here they are if you're interested. I don't really care about them. They're just there for reference. Growing at 4% a year. Dividend. Johnson & Johnson is absolutely outstanding with their dividend. Slowly and steadily growing their dividend over time. I think this is where you're going to derive a lot of your return investing in J&J because it's a big company. I don't think you're going to see a whole lot of growth happening out of J&J beyond inflationary growth. I think you're going to see a lot of the stockholder return coming from dividends. But good solid growth of dividends, something we like to see for a good sort of metric to look at the growth of the company. And so if you see this over time, over the past 10 years, you can somewhat assume that this is going to continue to happen. They're going to grow the dividend and grow their underlying free cash flow numbers to pay out that dividend. Total debt going up, increasing faster than assets at 6.69% a year. Cash growing from 21 billion to 23 billion. That's 4% a year. A lot of 4% a year in here. Debt going from 35 to 76 billion. So your net debt is increasing. That is a bit of a concern. It went from 35 to 76. That's a little bit over a doubling, right? If I'm doing math right, 35 times 2 is 70. So you're looking at more than doubling, while free cash flow has not doubled. You haven't doubled free cash flow yet. You're less than double on free cash flow, and you're more than double on net debt. I don't like to see debt growing faster than free cash flow. I see it growing faster than the business. That is not a good idea. Also, I don't like to see debt growing while you're buying back shares. If you're taking out debt to buy back shares, unless they're grossly undervalued, it's a stupid idea. Also, I don't like to see net debt going up when you're increasing your dividend. If you can't manage the dividend or buy back the shares without taking out debt, don't buy back the shares or pay the dividend. Simple as that, guys. I mean, I'm not a CEO of any sort of company out there, but I can see that I'm not going to take out debt to issue a check to my shareholders. It's not going to happen. Sorry. ROIC, you're looking at solid double digits there. Nothing to complain about, but I don't think it's really anything to go crazy over. Pharmaceutical companies usually have high ROICs. Johnson & Johnson is one of those that has a solid ROIC. For a big company, it is good. But for a pharmaceutical company, it's okay. This is what I was talking about earlier with the valuation. Like I said, fairly valued. Your current PE is 22. Your current price of free cash flow is 22.8. Your 5-year numbers are a bit higher, except for free cash flow, it's about the same. So you're looking at I would say, based on these metrics, a fairly valued stock. Not really overvalued, not really undervalued, just kind of hitting that middle ground. Maybe slightly above fair value, but I'd say fair value. Moving on, net debt to free cash flow. Net debt to free cash flow is 3.6 times right now. My problem is that debt is growing faster than free cash flow, so this multiple is getting higher over time. I don't want to see it get too high. For JNJ, for JNJ, it's a safe company. It's okay for them to grow the debt a little bit, but they need to be careful with how far they're going to take it. Something to look into. Revenue growth over the past 5 years, 4.17%. Earnings growth, that's playing off of that weird fluke year where it was only $1 billion in earnings. I never thought I'd say only $1 billion, but I just did. So you're getting this monster number. It's probably more in line with this 4%. Free cash flow growth 1%. Not really anything to write home about. 0.5% shares outstanding over the past 5 years per year. And ROIC over 9%. Yes, it is at 10.72%. Okay, so now that we've looked at the financials and we've looked at our metrics to kind of get a quick gauge on things, the next thing we need to look at is our forecast. I've been somewhat aggressive with JNJ. JNJ, I think you're paying for the moat rather than the growth. They're a big behemoth company in the pharmaceutical and consumer goods space. So I don't think you're going to see this growth. I said 4%. I'm assuming that's what inflation is going to be like over the next 10 years. Inflation's been running hot here lately. I think inflation is going to continue to run above the average. I'm thinking the average is 3%. So I'm going to go 4%. I think J&J should be able to take inflation and grow along with inflation with free cash flow as well as net income. I always grow these at the same rate for simplicity. There's no particular reason. If there's no particular reason to differ these two forecast growth rates, net income should grow in line with free cash flow. So I usually keep them the same. price to free cash flow multiple 15, net income multiple 15, just because that's the market average. JNJ is a big part of the market, a big company. You could justify that these are higher. However, I've kind of priced that into being aggressive up here. These could be higher because you'd be paying for the moat. I mean, you really would be paying for a moat here, a really strong moat here. So you could adjust these higher, which would increase your return. Based on price to free cash flow, you're looking at $169.97. Call that $170. Based on net income, you're looking at $173.36. Coming over here, our current share price is $174.34. We average our two price targets together, we only get $171.66. So you can already see we're going to have an issue of buying at a higher price than we're selling. So that's a bit concerning. Come over here to our IRR calculator, you realize it's not quite that bad. You're in at 174, you get these free cash flows, most of which I think would be in a dividend. You're out at 171.66. That is a 6% annualized rate of return. JNJ is a wonderful company. I think it's just to that point where they're fairly valued, slightly overvalued, but I wouldn't say overvalued. I think you could justify logic behind adjusting the numbers higher, either higher growth. I wouldn't be able to justify higher growth, but I could see a higher multiple, which would bring up this 6% to a higher number. Maybe you might be able to get up to a 10% market, but I think the best thing to do is kind of wait until this price comes down. Let's see, what's it got to come down to? What if it comes down to 150? You're looking at 8%, 125. You're looking at 11. So I mean, it's got to drop $50, let's say. It's got to drop $50. That's not a whole lot. That's not a whole lot. Even as a percentage, it's not a whole lot. For Johnson & Johnson to fall to, I think then it might be a good buy. I would definitely be much more interested at that point. But that's really all I have to say about J&J today. Comment below any sort of stock suggestions that you guys have, or any suggestions that you guys have about making better videos, or providing the best content for you guys is my goal for this channel. That's why I slowed down. I'm not posting every day. I want to spend some more time thinking about the content that I'm putting out there, rather than putting out a lot of content. Quality over quantity. So yeah, comment below. I will read them. I will look at them. Let me know what you guys think. Like, comment, subscribe, all that crap that YouTube people say. But beyond that, I will catch you guys in the next one.